Now, the rally did slow down towards the end of the week, but at least one of our guests thinks the truck rally has a lot more to go. In fact, he thinks we'll see 23,000 by Labor Day. Heritage Capital President and Chief Investment Officer Paul Schatz joins us now, and he's joined by Levin Capital Strategies CEO and Portfolio Manager John Levin. All right, Paul, so you're saying 23,000. Let's just talk about this week first. What did you make of what happened this week, and why was it that we made these new highs after the speech on Tuesday night?
I think as each day goes on, or each day has gone on, we've given investors less and less reasons to sell. I mean, just think of all those people who sold last February, who sold after Brexit, who certainly sold before and right after the election. So I think that they're being forced back in, very uncomfortably so. And I think each time Trump gives a speech that's really written and he's using the teleprompter, he's following the script, he's giving us more and more reasons. He's got great partners in Ryan and McConnell. This is the pro-growth agenda we haven't seen really since 2003.
Okay, but it's going to happen, right? I mean, that's when you talk about Dow 23,000, is that dependent on the actual tax cuts coming forward?
No, so my projection of 23, in 2010, my projection was Dow 20,000 before the bull market ended. After 5 straight closes above 20, our new projection is Dow 23,000. This is simply a quantitative projection. It's nothing to do with fundamentals. If you ask me what could risk that, what do I worry about? If this stuff gets bogged down in Congress and the Republicans start fighting about the pork or this or that, markets will get a little frustrated and cranky over the summer. I don't think that's going to happen, but that's the risk.
You know, John, one of the things that I felt was really important this week was last weekend, Warren Buffett told investors, in sort of in a nutshell, it's time to just put your money in index funds. Well, I actually tweeted about this on Monday. I don't always like to tweet about these things because you don't like what you hear back. But you have some thoughts about what's happened in terms of all the money that's been thrown into index funds and how in an index fund, there's no real price discovery. And that's got real long-term impact ramifications on the markets.
Yeah, I really do think that. And just to go with the previous question about the speech, President Trump at the end talked about 250 years of America. And I sort of got up actually this morning and said, well, it's 241 years. And after 241 years, how do I know that the price of the S&P should be 2377.75? There is no, when I think of the index, I don't know what the price should be. And I think it's easy to invest in the market to be bullish. It may be hard because of the complexity, which we'll get to, but there is no price discovery. Nobody really knows what the price should be. You can believe in America, you can be bullish, you can be apprehensive.
But does that mean investors who are now succumbing to index funds because they've given up on active management after many years of relative underperformance, does that mean that they're doing a bad thing? Is that a dangerous thing?
I don't think it's a dangerous thing. And I think this, in a way, it's a very interesting question. In a way, I think the stock market is so complex and the buying and selling is so professional that there is merit to the degree of indexing. I think, however, it is far better to buy a security at a reason you understand for a potential that you can identify against a risk you're willing to bear. And I think that's investing. And I think that investing is compelling compared to this process where you just buy an index, which is a rabbit. I mean, a lot of us who know how.
But the index does measure the overall sentiment, the overall market. And so, you know, for that investor who's not willing to put in the due diligence to look at a particular company and do all the research that you guys do, a lot of them like being in an index fund and looking at the Dow overall or the S&P overall or NASDAQ overall. So when we talk about the market as a whole, I think it is a fairly good sort of predictor of overall fundamentals and the overall health of things.
I think it's increasingly, after a 6 or 7 year bull market, been a measure of sentiment.
But sentiment's good, right? I think that's where we're going with this. Sentiment is very good right now, and it's because all of a sudden you're talking about economic policies that have not been discussed in some time.
Well, this sentiment is, go ahead, Paul.
But, you know, where was Buffett in March of 09 or the end of 08 pushing people into index funds? After 7 years of underperformance in active, now people, they started coming around last year, but now people...
Well, Buffett was one of the very few voices telling people to invest in America in 2008,
He was, but
2009.
he never pushed the index funds on people. This is a new thing. It was always John Bogle telling him that. Now it's Buffett. Look, to me, the the push into index funds is certainly a bell going off. This is the fourth quarter, if there's a football game, of the bull market, and clearly it's a sentiment. It's people are saying, you know what, I've had these active funds, I've paid more in fees, they've underperformed. The time to buy the index funds is after the decline, not after this huge rally.
What happens when people stop buying index funds?
Yeah.
I mean, fashion is a wonderful thing, but one of the recurring things is changes in fashion.
Well, we saw that in March. In March of 2000, we actually saw that. Another major theme this week was the lack of volatility. I think, Trish, it was reported that the last 24 trading days, if you go back over the last 50 years, you have not had a 24-day period in 50 years where you've had this lack of volatility. And John, that's something that is worrisome to long-term investors. The fact that the VIX is probably the cheapest asset out there, even though it's relatively overvalued, buying the VIX, buying insurance.
Right.
Why are no portfolio managers buying insurance now?
Because it's been so expensive, so uniformly wrong. I've bought 25 houses on the insurance that I've lost buying insurance. It fits with my view, actually, not to avoid your question. I can't answer so much why. I'm more interested in what might happen next. And I think...
So do you agree with 23,000?
What I think in general, I've never been a target investor. What I've always thought about is that the upside, because of various possibilities, is greater than people think. And I think people don't realize how much the market can go up.
Guys, stay right there. John and Paul will have much more to discuss on Wall Street Week. We'll get more into that after this break.